All right, let's talk about Domo's latest earnings report because this one is a real head scratcher. It's a classic Wall Street paradox. On one hand, you have the company popping the champagne for a huge milestone, but on the other hand, you have the market hitting the sell button hard. So what is going on here? Let's get into it. So here it is, the puzzle in a nutshell. Domo comes out and delivers what they're calling a landmark quarter. I mean, they hit their first ever positive non-GAAP profit. They beat their own guidance on revenue and earnings. That sounds like a home run, right? Well, look at the market's reaction. The stock gets hammered, dropping around 13% after hours. The headline said profit, but the stock price screams something else entirely. And that leads us to the big question we're going to tackle today. What on earth did the market see that the headlines missed? What was hiding in the fine print or in the guidance that made investors run for the exits? We are going to unpack all of it. Okay, first up, let's build the bull case. To really get why this was such a shock, you have to understand the story that the company was telling. And, according to Domo's management, this turnaround isn't just happening, it's actually picking up speed. This quote from CEO Josh James really says it all, doesn't it? This isn't some cautious, maybe we're getting better kind of statement. No, this is a full-throated declaration that things are really starting to move. Their story is all about a huge transformation that's finally paying off. And here's the proof they pointed to. What's really interesting here is the acceleration. New annual contract value, or ACV, is growing at almost 20%, the best it's been in 3 years. Salesforce productivity, a 67% jump, that's just stunning. And subscription RPO, that's basically all the future revenue they have locked in under contract, is up 19%. So these aren't just good numbers, they're numbers that are getting better and faster.
And here it is, the big one. Positive 2 cents per share. Now that might not sound like a lot of money, but for Domo, this was absolutely huge. This was their first ever quarter with positive non-GAAP earnings. This was the finish line they'd been running towards, trying to prove they could be disciplined and efficient.
Now this number, 108%, is so important. This is their net revenue retention, but specifically for customers on their new consumption-based model. See, anything over 100% means your existing customers are actually spending more money with you over time. This is the exact proof point management needed to say, see, our new model works, it's sticky, and it makes people want to use us more. Okay, so the numbers look pretty good, but what's actually making it all happen? Well, management says it's down to 2 big strategic moves that are really working: a complete change in how they sell their product and a massive push into partnerships. And you can see that first piece of the strategy right here. A whopping 75% of their recurring revenue now comes from these new consumption contracts. That is a massive shift from the old seat-based model. And it's not just about pricing. It's a strategic move to make it way easier for customers to get started, grow their usage, and, this is key, buy Domo through all those big cloud marketplaces. Which brings us to the second pillar, partnerships. The CEO calls this a new freeway for business, and you can see why. They're getting into bed with the giants. AWS, Snowflake, Google, they get listed on their marketplaces, they sell alongside their sales teams, and suddenly, Domo gets access to these amazing enterprise leads that, frankly, close at a much higher rate. It creates this awesome flywheel effect.
And this quote right here, this is basically Domo's entire pitch to the world. They're saying, hey, we're not just a tool to make pretty charts anymore. The big play is to become the essential plumbing, the infrastructure that powers all the AI that big companies are trying to build. That's a much more important, much stickier place to be than just being a dashboard tool.
Okay, that was a really compelling bull case, right? So now we have to solve the puzzle. If everything is going so well, why did the stock fall off a cliff? Well, it turns out the market got spooked by a couple of details that were kind of hidden behind those positive headlines.
Before we dig into the numbers, we gotta do a quick accounting lesson. You've got GAAP, that's the official by-the-book number that includes everything. Then you have non-GAAP, which is an adjusted number management gives you. They pull out things like stock-based compensation to show you what they think is the core performance. Investors, well, they look at both.
And right here, this is the first major red flag that sent investors running. While Domo was celebrating that plus 2 cent non-GAAP profit, which was a great beat, by the way, the official GAAP number was a loss of 56 cents a share. And that was a huge miss, like over 50 cents worse than analysts expected. For a lot of people, that gap between the pretty adjusted story and the ugly official reality was just way too big to ignore. And then came the second shoe to drop. Right after taking a victory lap for their first non-GAAP profit, management turned around and guided for the next quarter to be a non-GAAP loss again. Whoa. That immediately suggested that this new profitability wasn't sustainable yet. It signaled that they were going back into investment mode, and it just created a ton of uncertainty about when they'd ever be consistently profitable.
So you've got the bull case with this awesome turnaround story, and you've got the bear case with a massive gap miss and a guide back to losses. How do you make sense of it all? Well, for the next call, we look ahead and give you our take with our own equity research style rating.
Our verdict on Domo is outperform, plain and simple. We think the market completely overreacted to the short-term noise and is missing the bigger picture here, this fundamental strategic shift that's happening under the hood.
So here's our thinking. We see this whole fiscal year as a bridge year. Yeah, the investments they're making are causing that Q3 loss, but those investments are what's fueling this partner ecosystem, and that's the real long-term growth engine. The move to a consumption model is clearly working, creating real demand, and their whole pivot to being an AI infrastructure company, that is exactly where you want to be for the next decade. And, the final tell is that management actually raised its target for the Rule of 40. That's a key metric for SaaS companies, which shows us they're confident they can balance growth with profits down the road.
Okay, now for our outrageous but plausible trade idea. We're calling this one the AI infrastructure play. It's based on the idea that the market right now has absolutely no idea what to make of Domo's future.
And of course, the quick reminder, this is just for informational purposes. It is not financial advice. You have to do your own homework.
The idea is a long straddle. It's an option strategy where you buy both a call option, which is a bet the stock goes up, and a put option, a bet it goes down. So you're not actually betting on which direction it's going to go. You're just betting that the current confusion is going to end with a big, decisive move one way or the other. You profit if the stock makes a huge swing, up or down. And that really leaves us with the final question, the one at the heart of this whole story. Is this big investment in AI and partnerships just a temporary cash burn that's hurting profits? Or is it the fuel for an engine that's going to make Domo a true long-term game changer? The answer to that question is going to determine whether that big sell-off was a warning sign or one heck of a buying opportunity.